Welcome to Lesson 6. Lesson 6 covers 7 special tax rules for agriculture. Be sure to use the evaluation tool for Lesson 6 to see which parts of Lesson 6 are most relevant to you. This is part of a program of the LL.M program in Agricultural and Food Law from the University of Arkansas School of Law. This presentation is intended to provide general information on agricultural income tax issues and should not be construed as providing legal advice. It should not be cited or relied upon as legal authority. State laws vary, and no attempt is made to discuss state-specific laws. For advice about how these issues might apply to your individual situation, consult an attorney. This project is part of the Agricultural, Financial, Tax, and Asset Protection Program funded by the USDA Farm Service Agency. There were 5 lessons previously in this series, and this is the final lesson, Special Tax Rules for Agriculture. We're going to begin with Lesson 6.1, USDA payments. Farmers and ranchers are eligible for many different types of USDA payments. In general, these payments are taxable income. Most USDA payments will be loan proceeds, commodity payments, expense reimbursement contracts, which are sometimes called grants, or conservation payments. In addition, some farmers may participate in programs funded by the USDA, but not receive payments directly from the USDA. Proceeds from loans generally are not taxable. Loan interest expense is a business deduction if loan proceeds were used for ordinary and necessary business expenses, including asset acquisitions. This is the same for any non-USDA loan, because loan proceeds are not income. They are a debt which you must repay. If a loan is not repaid in full and any portion of the debt is forgiven, then the taxpayer may have taxable income. In Lesson 6.2, we will cover this situation. There is a special type of USDA loan that may result in taxable income, a non-recourse marketing assistance loan. The farmer or rancher may elect to treat proceeds from these types of loans as income when received. They will later deduct this amount from proceeds when they sell the crop. The farmer or rancher may also forfeit their crop to the USDA instead of repaying the loan with cash. In this case, they will recognize income in the amount of the loan and a gain or loss on sale according to the difference between the loan amount and the value of the forfeited crop. These types of loans are only available to farmers who grow certain commodities. The USDA has a variety of programs to pay producers of agricultural commodities. Some of these are regular programs and some are special programs related to disaster relief or unusual circumstances such as COVID relief. USDA program payments are taxable income unless Congress specifies that the payments are not subject to tax. These payments are reported on line 4A of the Schedule F, Agricultural Program Payments. The Value Added Producer Grant Program, or VAPG, is administered by the Agricultural Marketing Service. The Environmental Quality Incentives Program, or EQIP, is administered by the Natural Resources Conservation Service. Some of these programs reimburse farmers for their costs to implement a specific project. Other conservation payments come from other USDA programs. There are several. They may compensate farmers for removing land from production or for implementing certain conservation practices. Generally, all proceeds from conservation programs are taxable unless Congress has specifically stated that all or part of the payment is not taxable. You may also receive payments for participating in USDA-funded programs run by other organizations. These payments do not come directly from the USDA. They come from an educational institution, a nonprofit, or a state, tribal, or local government. If you are part of a USDA-funded program, you may have received payments to compensate you for your time, or for use of your land or facilities, or to purchase your products. Generally, record payments for your time and land use as other income on line 8 of Schedule F, and report crop sales as you would normally. The next lesson is Lesson 6.2, Debt Relief. When you take out a business loan, you do not have income. You have a new liability or debt, so loan proceeds are not taxable income when received. If a loan is forgiven rather than repaid, then the amount of loan forgiveness becomes taxable income. A lender who forgives a debt reports the amount of debt forgiveness to the borrower and to the IRS using a Form 1099-C. Taxpayers must report any income reported on a 1099-C as taxable income. There are special rules for how a taxpayer may offset this kind of income, and there are also special rules for what is called qualified farm indebtedness. So qualified farm indebtedness is under a set of special rules to exclude the cancellation or forgiveness of qualified farm indebtedness from taxable income. To qualify, the taxpayer must be able to show that for the past 3 years, more than 50% of all their income before deductions came from farming or ranching. The taxpayer must also be able to show that the proceeds of the debt were used directly in the farming or ranching business. Also, this exemption only applies to debt from a lender who is in the business of lending, so either a commercial lender or a government agency. A debt to a friend or family member would not qualify. A debt to the person who sold you the property also would not qualify. The exclusion may be limited based on the tax attributes and adjusted basis the taxpayer has in the underlying asset. See Publication 225, Farmer's Tax Guide, for more details, and be sure to discuss this situation with your tax advisor, because there are specific forms that need to be filled out with your tax return related to this exclusion. See IRS Form 982 and instructions. So, if you have debt relief, the lender should report the amount of debt relief to you and the IRS on a Form 1099-C. Generally, this means that this debt forgiveness must be included in income. Interest forgiveness does not need to be included in income. The 1099-C should show the amount of debt forgiven and the amount of interest forgiven. But you will not include the interest forgiveness part in income. The debt forgiveness part is included unless you qualify for the qualified farm indebtedness exclusion. Here are some other special rules for debt forgiveness. In addition to qualifying for qualified farm indebtedness, you may qualify for bankruptcy, insolvency, business property exclusion, or qualified personal residence exclusion. If you think any of these circumstances apply to you, you may want to read additional information from the IRS and consider seeking the counsel of a certified public accountant or an attorney licensed in your state. The Inflation Reduction Act of 2022 created debt relief for some farmers under Section 22006. Farmers who received this type of debt relief should have received a Form 1099 from the USDA and one or more letters explaining how the debt relief would be reported to the IRS. You can find additional resources on the tax treatment of USDA debt relief at the Southern Risk Management Education Center Ag Finance Tax and Asset Protection Program, ruraltax.org, the National Ag Library, and Farmers Legal Action Group. In addition to the resources mentioned, you should consult with a tax or legal professional with specific experience working with USDA credit programs. Now we're going to talk about mixed-use real property. Mixed-use property may also be property that is partially used for farming and ranching and partially used for some other income-generating activity such as rental real estate, hunting, forestry, or events. But we talk about mixed-use property in this lesson as mixed-use property that is used for the business of farming and ranching and also as the residence of the farm or ranch owner. So how is mixed-use property reported on the tax return? First, direct expenses go with each business. Then, shared expenses are allocated between uses or businesses. Allocated means divided according to the method that accurately represents actual use. So in a simple example, you have a house, a field, and a barn. The house is all the residence of the farmer and the rancher, and the field and the barn are all used in the farm or ranch business. Everything related to the house is personal. Everything related to the field and the barn is for the farm or ranch business. The maintenance of the driveway that goes to the house and the barn is a shared expense. If the mixed-use property is rented under one lease with just one combined rent payment, the rent should be allocated between the business and the personal portion. The personal portion of rent is the fair market value of the residence on its own, or a reasonable division of the rent based on the value of the residence and the value of the business property. If the business and the residence share one utility bill, the utility cost should be allocated between personal, no deduction allowed, and business, deduct on Schedule F. There's no deduction allowed for the portion of rent allocated to the residence. The portion of rent allocated to the business is deducted on Schedule F as a rental expense. For a property owned by the farmer or rancher, ownership and operating costs will include mortgage interest, property taxes, insurance, repairs, maintenance, and utilities, and depreciation. To allocate these costs, you need to know the fair market value of the business assets and the ratio or percent of total business assets to the total purchase price. The personal portion of mortgage interest and property taxes may be deducted on Schedule A as an itemized deduction subject to IRS limits. The business portion of all other ordinary and necessary expenses may be deducted on Schedule F or C for other types of businesses or E for rental properties, subject to other IRS rules and limitations. So, first, determine the fair market value of any depreciable assets purchased as part of the property, and then determine the fair market value of the land itself. Then total the depreciable assets and the land used in the business, and total the depreciable assets and land used for the residence, and determine the percentage that is business and personal. Then you depreciate the depreciable assets that are business assets, and you use the calculated percentages to allocate business and personal mixed expenses. So in this example, a house valued at $100,000, a barn valued at $50,000, and 10 acres of land valued at $40,000. The total purchase price was $190,000. The barn and the 8 acres of the land are exclusive business use. The residential use is the house and 2 acres of land. So the business percentage is the business use total, $82,000, divided by the total purchase price, or 43%. And the residential percentage is the residential use total divided by the total purchase price, or 57%. And of course, the two percentages have to total up to 100%. So the barn is a depreciable asset. It has a fair market value of $50,000, so you take a portion of the value each year as a depreciation expense in your business. Mortgage interest and property taxes are reported 57% on Schedule A, personal, and 43% on Schedule F, business. 43% of shared insurance and repairs and maintenance expenses are reported on Schedule F. There is no comparable deduction on the personal side. Any additional insurance or repairs that are only for farm and ranch expenses would be recorded 100% on Schedule F. When you purchase a property, you pay one price, but that price represents all the different assets on the property. A careful analysis of the values of each of the assets will help you come up with a true and accurate list of all the depreciable assets used in your farm or ranch business and a good ratio to use to allocate shared expenses. Be sure not to forget these assets that may be purchased with the land: growing crops, productive vineyards and orchards, fences, wells, irrigation, and timber. For more information on timber taxes, see timbertax.org. So some of you are wondering what to do if you already did not do that. Lesson 1 has a discussion of amended returns. So now might be a good time to go back and look at Lesson 1 and consider amending returns to correct if you haven't done this already. Generally, you can amend returns going back 3 years to claim deductions to which you were entitled. If you purchase a property you intend to use as a residence and a business, you should consult a qualified tax preparer to help you determine the value of the business assets and the allocation ratio for shared expenses. IRS Publication 587 covers business use of home and mentions Schedule F. You have to interpret home to include the whole property to apply the instructions of Pub 587 to a farm or ranch property. All right, and now we're going to talk about value-added inventory. For this lesson, value-added inventory includes anything where you have physically transformed from the product you grew, raised, or harvested and transformed it into a new product with different physical qualities. Examples include wine, beer, cheese, jam, nut butters, baked goods, fermented foods and beverages, spun wool, meat which has been custom cut, packaged and frozen, soaps and salves and candles and things like this. Growing crops and animals held for sale are not treated as inventory for tax purposes for most farms and ranches. See Pub 225, Chapter 3 for an additional discussion about why growing crops and animals are generally not treated as inventory. So we're talking about inventory with respect to things that have been physically transformed from the raw agricultural commodity. Supplies and inputs on hand at the end of the year are sometimes called prepaid supplies, and sometimes they're called supplies inventory. The treatment of supplies and materials used in your farming operation were covered in Lesson 2. You can also see Pub 225, Chapter 4. So there's a special tax treatment for value-added inventory. Prior to 2018, taxpayers were generally not allowed to deduct the cost of value-added inventory before the inventory was sold. Since 2018, taxpayers have new choices which can allow them to deduct some inventory costs before the inventory is sold. Inventory is a type of asset account. That means it appears on the balance sheet along with other assets like cash, accounts receivable, and equipment. Assets are not types of expenses, so they are not deducted except according to special rules. An inventory item is an asset, and it becomes an expense when the item is sold. the dollar value of the inventory asset and the dollar value of the cost of goods sold expense is calculated using an inventory method. There are several acceptable inventory methods for management purposes and for preparing financial statements. For tax purposes, we talk about a tax inventory method. So if you incur the expense and sell the items all in the same year, you may choose to do inventory accounting for internal management purposes, but you do not have to do inventory accounting for tax purposes. If you have a cost to create inventory item in 1 year, but the item is still on hand at the end of the year, and you reasonably expect to sell it in a future year, then you need to make a choice about how you will treat the items for tax purposes. Since 2018, taxpayers with less than $25 million in gross revenues may choose to use a simplified inventory method called the Non-Incidental Materials and Supplies, or NIMS method, or they may report inventory on their tax returns using the methods they use for their internal accounting or the method used on their CPA-prepared financial statements. The NIMS method is generally the simplest and most advantageous method because it allows taxpayers to deduct some inventory-related expenses without keeping detailed records on all inventory costs or specific sales of inventory items. NIMS is only used for tax purposes. It is not a method that creates accurate inventory valuation for purposes of managing a business or creating formal financial statements for lenders or other outside users of the business. A taxpayer chooses the NIMS method by making what's called a NIMS election. A taxpayer chooses the inventory method they will use for their business by filing the tax return the first year the inventory method is used. Whatever method they use, knowingly or unknowingly, on that first return is the method they must use going forward for that business for that type of inventory. Obtaining IRS permission to change accounting methods is a costly and cumbersome process. So if a taxpayer does not choose a method, they have by default chosen the method that they were using, even if they didn't know it. So it's true even if the taxpayer doesn't know that they have made this choice. If a taxpayer does not choose a method, then they should either elect the NIMS method, or they elect the method used for their internal management or the CPA-prepared financial statements, or they run the risk of the IRS determining that whatever was used as the default was what was elected, and that's the internal management records, which are not necessarily the most advantageous for tax reporting. So you elect the NIMS method, which is the easiest and most advantageous, by reporting NIMS inventory on the tax return the first year that there is value-added inventory on hand at the end of the year. This is called a protective election. By electing NIMS, you protect yourself against the IRS determining your taxable income using another, less favorable method. The worst-case scenario is that a taxpayer is unaware of these rules and the IRS audits the return. If the IRS cannot see evidence that the taxpayer kept a NIMS inventory for tax purposes, the IRS will consider the taxpayer to have elected to use a book method, and the IRS may determine that the book method in use, which is any set of records the taxpayer keeps if those records associate a quantity and dollar values. The IRS may use those internal records and say that that was what was reported on the tax return and recalculate taxable income using the taxpayer's inventory records. NIMS only requires you to consider direct costs in inventory. That means only supplies purchased or contract labor associated with custom-packed products. You do not have to include the cost of wages you pay or any of the overhead associated with your facilities when you calculate NIMS inventory. That means you can deduct those costs in the years they are paid. Most book inventory methods require including these other costs in inventory. So to make a NIMS election, determine the costs that go into value-added inventory. For NIMS, direct costs are supplies and materials you purchased to create or pack the product, or the cost of custom processing or packing. Determine how much value-added product associated with those costs is on hand at the end of the tax year. That's generally going to be midnight on December 31st. Report supplies expense at the full amount on line 28 of Schedule F. Add a new expense line called Less NIMS Inventory Adjustment and record the amount calculated in Step 2 as a negative. When you account for NIMS inventory, it typically means that you may not take a current year deduction for expenses you paid in the current year. Instead, you deduct those expenses in the following year. If you do not account for inventory correctly on your tax return, it means that in the first year you have over-deducted and thus possibly underpaid your taxes. In all of the subsequent years, you will both under-deduct and over-deduct. You will under-deduct by the amount you over-deducted in the prior year, and you will over-deduct by the amount that should be deducted in the following year. If your year-end inventory amounts do not fluctuate that much, there will be minimal tax effect after the first year. However, if you fail to account for inventory correctly and are unable to show the IRS records of your reasonable inventory calculations, the cost of working with the IRS and correcting your records and your prior tax returns can be greater than the total amount of taxes underpaid. This is why it is safest to make the NIMS election and show a NIMS adjustment each year. If you have an operation with value-added inventory on hand at the end of the year, you should be using a double-entry bookkeeping system. Lesson 2 reviews what the IRS requires in terms of records. As your business grows in size, volume, and complexity, the requirements for clear and accurate records also increases. What may be adequate to represent the business activities of a small, simple business will not be adequate when that business grows and becomes more complex. So to make a NIMS election, tell your tax preparer that you want to make a NIMS election on your tax return. Describe to them the value-added inventory you have on hand at the end of the tax year. Let them propose an amount for the NIMS inventory adjustment. Review the amount and the calculation with them and approve the adjustment. And ask them to give you the adjusting entry to make on your books. If you want to be successful with a value-added business, your success will depend on your ability to manage inventory. Managing inventory means knowing the cost of your inventory and knowing how fast or how slow your inventory sells. NIMS is probably the best tax method for reporting inventory, but it is not the best method for actually managing your inventory to maximize profits. One of the things you can do with the value-added producer grant funds is to pay to design and implement good inventory systems for your internal management purposes and for proper tax reporting. Other resources include the small business development centers, which are associated with community colleges in most communities, and they may be able to help you set up or clean up and improve your bookkeeping system and establish methods for tracking inventory. You can locate one at sbdc.net. All right, now we're moving to conservation programs. So, first there are annual conservation expenditures. These are conservation practices that are part of your normal annual farming practices. These are usually deducted as ordinary and necessary business expenses. These are practices that are part of how you increase soil fertility, manage weeds and pests, improve the quality of your product, and provide for pasture or forage. For example, if you plant annual cover crops as part of your normal plan for soil fertility, that may be considered a conservation practice, and those costs are also part of your ordinary and necessary farming costs for the year. There are also conservation expenditures for assets. Assets that are integral to your ongoing farming or ranching operation and also part of the conservation strategy are treated like any other farm asset and depreciated according to the regular tax rules for depreciating assets. Using hoop houses and cross fencing are both recognized by the USDA as conservation practices, but there are no special requirements to report them as conservation practices when filing your income tax returns, because the practices are also integral to how you produce crops or livestock. So, for example, if you buy or build a hoop house and use it in your normal operations, you would capitalize the cost of the hoop house, that means to treat it as an asset, and take a depreciation deduction according to the usual rules for asset depreciation discussed in earlier lessons. On a ranch, if you cross-fence your property to improve pasture management, you would capitalize, treat as an asset, the cost of the fence, and take a depreciation deduction according to the usual rules for depreciation. There are other conservation expenditures that are not directly tied to production. These include soil or water conservation projects such as grading, terracing, planting trees as windbreaks or hedges or grassed waterways, some kinds of livestock, ponds, or some kinds of fencing off of waterways. Projects to create or enhance habitat, especially for rare, threatened, or endangered species, are also considered conservation expenditures not directly tied to production. These practices, designed to protect soil and water, prevent erosion, and protect certain endangered species, are not necessarily considered part of annual production, but they may ultimately improve the productive capacity of the land. The taxpayer may elect to deduct these conservation costs that are not directly tied to production, as long as they are in the business of farming or ranching. The land was previously used for farming or ranching, so not for land recently brought into production. And as long as the conservation expenditures are to implement a conservation plan approved by the USDA Natural Resources Conservation Service. Gross income for farming or ranching, in this case, includes gains from sales of breeding or of dairy, livestock, or draft animals. So to deduct conservation expenditures not directly tied to production, the deduction for each year is limited to 25% of gross income from farming or ranching that year, including gains or sales of breeding or dairy livestock or draft animals. Any excess deduction may be carried forward for future years until fully deducted. If you participate in the NRCS EQIP program, you will receive income to compensate you for the cost of implementing an approved conservation practice. See Lesson 6.1 for the tax treatment of the income from EQIP. Expenditures to complete an EQIP-funded project are treated as discussed above. First, as ordinary and necessary business expenses if they're part of the annual operation. Second, as the purchase cost for assets used in the ordinary cost of business if the assets are used in the ordinary course of business. Or third, as land improvements subject to deduction limitations for those conservation projects that are not directly tied to annual production practices. The USDA also makes other payments related to conservation practices. See Lesson 6.1 for a discussion of the tax treatment of those payments. Now we're going to talk about catastrophe and disaster. So the rules for calculating a loss are the same for theft and casualty. You do not need to prove that a property was stolen. You do need to show that it is no longer available for use in your business. Casualty means anything sudden and unexpected that causes the property to become unusable or significantly less functional. A gradual decrease in functionality is not a casualty. Common causes of casualty loss include fire, flood, hurricane, tornado, volcano, earthquake, unexpected outbreak of disease, theft, and vandalism. Special rules apply when casualty losses occur as a result of a federally declared disaster. Note that there are different rules for losses of non-business property, such as a personal residence and its furnishings. This lesson is about business property. So, for crops and livestock held for sale, most farms and ranches earning less than $25 million a year report taxable income and expense without accounting for inventories of crops or livestock. When the crop or livestock is lost, the farmer or rancher does not have additional costs associated with the crop or livestock. They just have less opportunity to earn revenue. This means that most of the costs associated with growing a crop or raising livestock are deducted in the year the cost is incurred, with a possible allowance for non-incidental materials and supplies inventory, as discussed in Lessons 2 and 6.2. So, generally no additional loss, but there are some special rules, and that's what we're going to talk about next, and Lesson 6.6a talks about additional rules for livestock. So, crop insurance is a type of insurance intended to replace lost earnings when crops or livestock cannot be sold due to an event covered by the insurance. Most crop insurance is purchased from private insurance companies who offer insurance through a partnership with the USDA Risk Management Agency. This is known as federal crop insurance. Federal crop insurance is available for hundreds of different crops grown in hundreds of different locations. Private crop insurance is available for coverage of limited crops and usually just for damage due to rain and hail. In addition, for crops which cannot be covered by federal or private crop insurance, the USDA Farm Service Agency offers a non-insured disaster assistance program, which is called NAP for short. The USDA may also offer occasional programs to compensate farmers and ranchers for lost revenue following a federally declared disaster. Some businesses also have private business interruption insurance to compensate for lost revenue related to an insurable cause of loss. All of these types of income are taxable unless Congress has specifically stated that a certain type of program payment is not taxable. Report proceeds from federal crop insurance, NAP, and other federal disaster assistance on line 6 of Schedule F. Payments for lost income are generally taxable, but a taxpayer may elect not to be taxed on crop insurance or disaster relief payments in the year received, and instead they may defer the payment to the following year. This is now about business property. So we're just talking about loss of crops and livestock. Now we're talking about loss of business property. These are assets used in the business. This includes land improvements such as roads, irrigation ponds, planted windbreaks, buildings, fences, wells, irrigation systems, tractors, trailers, implements, small tools, trees and vines, and bushes that produce annual crops. Also, livestock that is not held for sale but is used in the business, including roping horses and working dogs, breeding livestock, dairy animals, laying hens, and animals held primarily to produce fiber. These types of assets may be protected with your private property insurance. If they are destroyed, you will receive a payment related to the loss of value or the replacement cost of the asset. There are a few USDA programs specifically for loss of business property, including the Tree Assistance Program and the Livestock Indemnity Program. So there are two aspects to taxation for casualty losses of business property. The first is the treatment of the depreciable asset, and the second is the treatment of any proceeds received from insurance or salvage sale. For tax purposes, you will have a gain or loss related to the lost use of the asset. If your taxes are prepared by a tax preparer or computerized tax preparation software, you should have a list of all tax assets and the amount of depreciation taken to date. If you do not have this list, you may need to recreate it. If you have not properly reported assets and depreciation in the past, you may need to amend prior year returns. This is covered in Lesson 2. If you do not have records to show that you have tax basis in an asset, you should assume that your tax basis in the asset is 0. So why this matters? You'll have a taxable gain or loss equal to the difference between the insurance or salvage sales proceeds and what's called the tax basis of the asset. So to find the tax basis, you identify the asset on the asset list, identify the original cost, and the total amount of tax depreciation deductions taken to date, or accumulated depreciation, and the difference between that original cost and depreciation taken to date is the tax basis of the asset. So here's an example on a tax loss. For a purchase price of $2,000 with accumulated depreciation of $1,500, there's a $500 tax basis. Insurance proceeds are only $250, but you also have a salvage sale of $50. That means you have total proceeds of $300 and a tax basis in the asset of $500. That's a tax loss of $200. You could also have a tax gain. In this example, a purchase price of $2,000 with accumulated depreciation of $2,000, so a tax basis of 0. Same situation, insurance proceeds of $250, salvage sale of $50, total proceeds of $300. In this case, $300 minus the tax basis of 0 equals a gain of $300. If you were given an asset, your tax basis in the asset is the same as the tax basis of the person who gave it to you. Unless you can show a tax basis greater than 0, an asset received as a gift probably has a tax basis of 0. If you receive an asset as an inheritance, your tax basis is the fair market value of the asset on the date of death of the person from whom you inherited. Alternatively, you can elect to use the fair market value of the asset 6 months after the date of death. Typically, you will need a written appraisal or other written evidence, such as examples of similar items available for sale, to establish your basis in an inherited item. All right, if you have a tax gain from an asset loss, you may delay recognizing the gain as taxable income if you use the proceeds to restore or replace the original property. So this is called an IRC, Internal Revenue Code, Section 1033, election. You can get additional information regarding this election from a qualified tax preparer. What we're wanting to say in this presentation is that this exists, and if you use proceeds to replace the property you lost, you may be able to avoid being taxed on the gain in the year of the sale by adjusting the basis of the new property to account for the gain from the old property. You will not be able to deduct the full replacement cost through depreciation. If you sell the asset, you will recognize the postponed gain at the time of the sale. There are a number of additional considerations regarding when you acquire the new property and what type of new property qualifies. The purpose of this lesson is to make you aware of this option. You will need additional information regarding IRC 1033 and the assistance of a qualified tax preparer in order to actually make the election. Finally, cleanup and recovery costs. Cleanup and recovery costs are generally deducted as ordinary and necessary business expenses. To the extent that cleanup and recovery involves repairing or replacing assets, costs must be capitalized and later deducted through depreciation. And now we arrive at the final lesson, livestock losses and weather-related sales. There are special USDA programs to make payments to livestock producers for losses due to disease, bad weather, and fire. These include the Livestock Forage Disaster Program, LFP, the Livestock Indemnity Program, LIP, Emergency Assistance for Livestock Honeybees and Farm-Raised Fish. Congress or the USDA may create additional programs for livestock producers. Payments from these programs are generally taxable unless Congress specifically excludes the payments from taxation. Remember that bees and farmed fish are livestock for purposes of USDA livestock programs. The Livestock Forage Disaster Program pays producers who have lost access to grazing or forage due to drought or fire. The Livestock Indemnity Program pays producers for livestock deaths caused by adverse weather or predation by reintroduced predators or those protected by federal law, such as bears, wolves, and avian predators. The Emergency Assistance for Livestock Honeybees and Farm-Raised Fish Program pays producers to compensate for losses due to disease as well as adverse weather and wildfires. See also Lesson 6.1 for more information on the taxability of payments from the USDA. The rest of this lesson is about the tax treatment of gain when the taxpayer sells livestock due to weather-related events such as loss of pasture, forage, or the supply of feed or water. These loss of pasture, forage, feed, or water would cause the taxpayer to sell animals that they would have otherwise kept. So, in a typical sales year, you would have sold 2 breeding cows, but because of a drought, they sell 6 breeding cows. There is an election available for the income from the 4 additional cows that were sold. So the election is available for sales in excess of the amount that the taxpayer would have normally sold if the adverse weather conditions had not occurred. There are 3 different options for taxpayers to delay paying tax on the net proceeds from weather-related sales of livestock. There's a 1-year delay, a 2-year delay, and a 4-year delay. All these options are elections to defer recognition of income from the year in which it is received to a future year. Preparers will talk about deferring income or deferring gain from the year the income was received to a future year. When you report the income in a future year, a tax preparer would say you are recognizing the income or recognizing the gain. So there's a 1-year delay available for all types of livestock if the sale is due to events declared as a federally designated disaster. There's a 2-year delay available only for draft and dairy animals or breeding animals other than poultry. And there's a 4-year delay available only for draft and dairy animals or breeding animals other than poultry if the sale is due to events declared as a federally designated disaster. To make the election to delay reporting income from sales of livestock due to the effects of a federally designated disaster, you must attach a statement to the tax return that covers the year in which the sales took place. State that the taxpayer is making an election under Internal Revenue Code Section 451E. Refer to the date and area of the federal disaster declaration. Explain why the disaster caused you to sell the animals sooner than you otherwise would have. Provide the number of animals sold in each of the 3 prior years. Provide the number of animals you would have sold in the tax year if the disaster had not happened. Provide the total number of animals you actually sold in the tax year. Provide the number of animals you sold during the tax year due to disaster. Provide a calculation showing the amount of income you elect to report in the following tax year rather than the current tax year. There are special rules for livestock sales if the sale is for livestock other than poultry. The livestock is not usually held for sale, but instead it's held as working animals are used for breeding or dairy. The livestock is sold in response to a weather-related event such as drought or flood, and the number of livestock sold is greater than the number that would normally have been sold if the weather event had not occurred. This is for 2 or 4 year delays. The usual tax treatment for the sale of livestock not held for sale is that since this type of livestock is treated as a depreciable asset for tax purposes, when a depreciable asset is sold, the taxpayer recognizes a gain or loss equal to the sales price less the tax basis, and the gain or loss is recognized in the tax year covering the sale. A depreciable asset has a tax basis generally equal to the purchase cost less all depreciation deductions taken. Livestock born and raised on the farm or ranch will generally have a tax basis of 0. Livestock received as a gift will have a basis equal to the basis of the person who made the gift. Livestock received as an inheritance will have a basis equal to the fair market value of the livestock at the date of death of the former owner. If livestock not held for sale are sold in response to adverse conditions created by weather, typically loss of feed, water, or forage, the taxpayer may elect not to be taxed on the gain in the year of the sale. This election requires the taxpayer to replace the property with similar property within 2 years, or if the weather-related event was a federal disaster, then within 4 years. The gain that would have been taxable in the year of the sale is taxed in future years by reducing the basis of the replacement property. The basis of the new replacement property is decreased by the amount of gain that would have been recognized in the year of the sale. The taxpayer's depreciation deduction for the replacement property is decreased by the gain not reported in the sale year. When the taxpayer sells the replacement property, the gain on the sale is calculated, including the reduced basis due to the deferred gain from the original sale. The purpose of this lesson is to make you aware of these options. You will need additional information and assistance in order to make this election. See Pub 225 and ruraltax.org for more information on the tax rules for weather-related sales of livestock and on how to make the election. And that brings us to the end of this series. For more information about federal income taxes for your farm and ranch, there are previous lessons in these series. For each lesson, there's a short set of questions you can answer to help you decide if the training will be useful to you. You can access the questions and the trainings at this link, and there are additional project resources available at the agftap.org website. In addition, you can always refer to IRS Publication 225, the Farmer's Tax Guide, to ruraltax.org, and to other IRS websites and publications. Thank you very much.